All right, everybody. Happy Friday. I'm Phil Hodgin. Here we are at the brand new and improved time of day for the Hodgin Law PC International Tax Lunch. It's 9 a.m. on the West Coast. It's lunchtime on the East Coast. We moved it starting this month because there are a lot of people in Europe and UK and beyond who are watching this, and really, do you want to be listening to tax at 9 p.m. on a Friday night at home, maybe with a glass of wine to enhance the experience? Yeah, but no, you don't. So that's why we just moved the start time 3 hours earlier. So last Friday of the month, noon is no longer the case. 9 a.m. Pacific time, noon Eastern time is the new time for the International Tax Lunch. And for those of you on the East Coast, have a happy lunch. This month's topic is going to be foreign disregarded entities and Form 8858. And deceivingly simple, but there's a few little weird things that we will come across as we come along, and you'll see them as they go. But the idea is here just to give you an overview of foreign disregarded entities, how it sort of mechanically works, and a little bit of why would you do this. For those of you who are interested, on May 15, 2025, I am going to be speaking at the Washington State Society of CPAs International Tax Conference in Bellevue. It's also going to be webcast, and I will be doing a 1 hour presentation again on foreign disregarded entities, but more about the use and abuse of them. The use cases, what do you do? When are they cool? When do they suck? And that kind of thing. So if you want to sign up for that, heavily recommended, just search the Google for Washington State International Tax Conference, May 15, 2025. Attend in person if you come, and if you do, at the end of the day, we're all going to go down to the bar and the drinks are on me. If you don't, you want to webcast it, or you can't get to Bellevue, watch it online and heckle from afar. All right, here we go. The table of contents, as usual. Introduction, because you have to have one. There are two things that trigger the Form 8858 filing, one of which is you're an owner of a foreign disregarded entity. That's number two. And then number three, we're going to talk about how a foreign disregarded entity comes into being by election. There's another way to do it as well. And I'll talk about that, of course. We'll talk about the tax effect of making that election, what happens when you make an election in terms of the repercussions in the Internal Revenue Code. And then the second category of people who must file a Form 8858 are those who operate a foreign branch, in quotes. And foreign branch includes a thing called a qualified business unit, in quotes. And we'll talk about what those are and a little bit of the implication for human beings. It's probably a lot easier for a corporation that has a branch, or a corporation that owns a disregarded entity, or a qualified business unit. But for humans, it's sometimes a little bit murky. We'll talk about that. There, 6 categories of Form 8858 filers. The government knows and loves categories of filers. If you do 5471s, 8858's no exception. And then we'll talk about the weirdness of the penalties and how human beings are not at risk at all of oopsies on late filing or non-filing Form 8858 penalties. So let's go. Intro time. Summary. As I've said, just going over the table of contents, who has to file? U.S. persons who are tax owners, and that's a phrase out of the instructions, of foreign disregarded entities. U.S. persons who operate a foreign branch, and foreign branch includes this thing called a qualified business unit. And then people who own interests in controlled foreign corporations and controlled foreign partnerships, and hanging underneath those CFCs or controlled foreign partnerships, there is a branch or there is a disregarded entity. So that's what we've got. Those are the people who have to be filing a Form 8858. We're going to talk now about disregarded entities next, after a long and exciting discourse on foreign disregarded entities. We're going to talk about foreign branches and then categories and the penalties. Starting with foreign disregarded entities. What is a foreign disregarded entity? It is a foreign eligible entity. We're going to go through a whole bunch of definitions for the Internal Revenue Code. So foreign eligible entity has one owner, because if it had two owners, it would be a partnership, that is classified as a disregarded entity, either by default or by election. And here's my little handy dandy flow chart, because I love making flow charts, where you can sort of see the progression from you looking at a thing, an entity, and saying, what is this thing? And can I make a check the box election for it, all the way from start to finish with a yes or no answer. And we'll go over each of the little the shapes in detail in the next few slides, but just to give you an overview, you see the rectangular boxes. You come to diamonds or questions, rectangular boxes or answers. You come to an answer. This is a business unit, entity. You've decided by analysis, this is a quotes business entity, close quotes. And then you come to the analysis and you say, this business unit entity that I have is an eligible entity. And then you finally come to the point where you say, well, it's foreign. So now I have a foreign disregarded entity. The other alternative is, of course, it's a domestic entity. We're not talking about domestic entities today. So first, what is a business entity? Regulations. Okay. Government speak. Let's just talk about it. Look at this paragraph. He says, for purposes of this section and section 301.7701-3, what this is saying is they don't care what you think a business entity means in real life. They don't even care what business entity means in every other part of the Internal Revenue Code and every other part of the regulations. They're just saying for these two specific regulation sections, business entity has a special purpose, meaning. And what it says here is, you see the bolded things. You've got this thing bolded, trust, or a business, an entity that's otherwise subject to special treatment. So I want to back up here. And why am I being so pedantic about this? Is because when, like, I certainly think of it, yes, I think of an entity, well, it's either got to be a trust or it's going to be a business entity, right? Because what else is there? Well, there's some secret third thing for purposes of the check the box election, which is this group of entities that are, quotes, otherwise subject to special treatment. So just bear in mind, I mean, this is sort of a general thing for reading and understanding the code. They recycle definitions, and you'll see further on where we talk about foreign branches, and they tell you, hey, use this definition in the 367 regulations, and then you look in the 904 regulations, there's another definition of foreign branch. So you have to be really, really careful when you're going through and not make assumptions on what you're dealing with. So rant over, let's move on. What's a trust? Trust is basically a thing that holds investments passively for safeguarding it for the benefit of other people, the beneficiaries. And trusts are not, conversely, entities that are created to run a business in, associates in a joint venture enterprise for the conduct of business for profit. And there are plenty of entities that have the word trust in them, and you can see an extensive definition and discussion of that in the regulations, section 301.7701-4B. And I personally don't come across them, Massachusetts Business Trust or whatever they are, and land trusts and all this sort of stuff. That's not part of my real world. But what is part of my real world is foundations in Europe and every civil law country, where a foundation, if you look in the regulations and whatever blather the IRS has published, they say, well, we can't really tell whether this civil law foundation is a trust or a business entity. It all depends. And it depends on how it's organized. And the other one I see with increasing frequency is unit trust in Australia, where you can have something that behaves a lot like just a trust. Or you can have something that's configured as if all of the economic benefit sits with somebody who has really no control over the enterprise, and all the control sits with somebody else by having different classes of units in the unit trust. And that kind of looks more like a business entity, right? And the problem is here, I had one of these with a civil law foundation in Europe, and I was on the edge, and I wanted to make absolutely sure that this thing was going to be classified as a trust and not as a business entity. And I banged my head against the wall a lot of times, and then I thought to myself, well, I'm really brilliant. Here's what I'm going to do. I'm going to file 8832 and elect to be a pass-through, and then I'm going to start filing this thing as if it's a trust. And if the government agrees with me, I got a trust. If the government disagrees with me that it's a trust, then hey presto, I've got a disregarded entity. I'm all good, right? Well, a phone call to chief counsel's office later that disabused me of that notion, and I'm telling you this because it's important. When you file a form 8832 and you get that letter back saying you're classified as whatever you're classified as, that's not binding on the government. That's what chief counsels told me said. So I gave up on that, and I just went straight forward, and I treated the whole thing as a trust, this foundation, and we'll just hope for the best. So the point here is it can get murky at the edges. Our patron saint, Vilfredo Pareto of the 80-20 rule. I don't like to deal with the 20%, but every now and again, you stub your toe on that rock, and you have to. Okay, so that's trust. Let's just assume, because in real life, one of these head burners comes up every 5 years for me. It's not a big deal. Let's talk about this other thing, these entities with special tax treatment, which are not classified as business entities for purposes of check the box election. And you see a little excerpt out of the preamble to the final regs for the check the box regulations. And they give two examples, qualified settlement fund and a remake, so you've got those two. And I've given you a couple other bullet points, qualified subchapter S subsidiaries and qualified REIT subsidiaries. None of these things happen in the real world to people like you and me. And the other thing is, these are all business entities. And I haven't done an extreme search through the code for all of the types of entities that have special tax treatment, but I'm going to guess with a high degree of certainty that they're all going to be domestic entities that have special tax treatment. So they're corporations that have some sort of special weirdness for tax purposes. And they're domestic, and they don't care. We don't care because we're talking about foreign entities. So let's move on. So just note this phrase, special tax treatment exists. It's not going to matter to you. All right, let's assume now you've heroically come to the decision that you have a business entity. Now what? Now we go on to the next stage. Is it an eligible entity? So in other words, it's a business entity, but is it eligible to make the check the box election? This one's easy. An eligible entity is every business entity that is not a per se corporation. Per se corporations are defined in Reg Section 301.7701-2B, and in particular, foreign per se corporations are listed at B8. And so all you have to do, which is way easier, is just grab page 7 of the Form 8832 instructions, and you look and see a list. And is my thing there? If yes, then I've got a per se corporation. If no, I'm good to go most of the time. You may find that you have an entity here that is listed, like in Spain or Mexico, Sociedad Anónima, sorry. But you might find one that has a bunch of words after that that phrase, sociedad anónima. For instance, I recently dealt with one where it was an entity that owned a lower tier Spanish football team. And after the word Sociedad Anónima, there's a Deportiva. And a call to chief counsel's office occurred, and we brainstorm and agree that this is probably just a different flavor of a per se corporation. So check the box elections not allowed. So 99% of the time, again, you're going to find your answer here in the instructions of Form 8832, what is not an eligible entity. But again, there will be edge cases. And edge cases for me in this context are even less common than edge cases elsewhere. I mean, like happened 2 or 3 times in my career from what I remember. So not a big deal. You're going to get the right answers this way. Finally, so we got a business entity. We decided it was an eligible entity. Now do we have a foreign eligible entity? This one's easy peasy. You look at the organizing documents for the entity, and if it says one of the states of the United States or the District of Columbia, then it's going to be a domestic entity, and a foreign entity is something that's not domestic. If the organizing documents say any other location, then it's going to be a foreign entity. So this is just a matter of checking the documents. So when somebody tells you the name of the entity, don't assume that you can figure out what type of entity it is from the little initials or the words after the name of the entity. Go look at the documents that formed the entity itself, and you'll find out domestic or foreign. So now we've come to the point where we have a foreign eligible entity. Next question is, do we have a foreign disregarded entity? And a foreign disregarded entity is something that is a foreign eligible entity and something happened to it. And specifically, the classification. It is classified as a disregarded entity, either because the regulations say so, you are one by default, or because the regulations say, well, you're eligible to make an election, and you actually do make an election. So those are the two ways that you transform an eligible entity into a disregarded entity. So let's talk first about this one owner thing. And this is a little bit weird, and it's a little bit different from what you experienced and understand about life if you're thinking CFCs and indirect ownership and all of that kind of fun stuff. Things don't operate quite the same way with a foreign disregarded entity. So when do you know that you have one owner? If you look at the instructions for Form 8858, it talks about this concept of a tax owner. Now, the instructions are not clear. Sometimes you read the instructions for Form 8858, or I do, and you think, yeah, you're gargling with rocks. Tell me what you mean. But the idea here behind a tax owner is, you have a disregarded entity, and so you're treating the upstream owner of this entity as the real owner of everything, and you're treating the upstream owner as the actual recipient of the income items and whatnot. And that's the tax owner. For tax purposes, everything hits the sole member of the LLC, for instance. And direct ownership, of course, is easy peasy. You've got a document that says one name of one human being is the sole member of this thing, or you've got a Bahamas corporation that you want to make an election for, and you have one shareholder, and that's easy. Spouses are a little bit more difficult. I mean, you've got two humans, right? So theoretically, that's separate. But at least in the context of community property locations, we have this Rev Proc 2002-69 that says that the spouses can elect to make that entity either be a partnership or a disregarded entity, their choice. So I have not found any extension to that to non-community property jurisdictions. But, if you know of some, please tell me and email me, phil@hodgen.com, and tell me where my brain is missing a year or two. And the thing I commend to you is if you, like me, are in a community property jurisdiction, so I have the California community property rules sort of baked into my brain, both as a tax lawyer and because I'm married and living in California. And community property rules are generally similar around the world, but they rhyme, they're not identical. And so just because you've identified, let's say, Spain as a community property place, because it is, doesn't mean that your assumptions are correct, that Spain operates just like California, because it doesn't. I mean, California community property rules are not the same as Washington, for instance. Even within the United States, they differ. So you're further down the road, but it's not necessarily going to be true. And I had reason to look at Denmark in the last couple of days because of a US person moving there. And it's not the same. And it's not really community property, but there's a division of property if there's a divorce. And, there's every place has a different thing. And the question is, I personally think that the IRS, if you have a community property spouses and they make an election, it's going to be fine. But you have the edge cases against. What if you have me and my wife and we have an LLC and it's a disregarded entity and we move to Illinois, for God's sake, and it's not a community property place? Isn't that what happens? Does it continue to be community property? No. Edge cases, you drive off that bridge when you come to it. Let's talk about indirect ownership that does make you a tax owner of an eligible entity. So on the far left, we have a situation where you have a foreign eligible entity and it has two owners, one of which is the human, and the other one is a disregarded entity. Let's say a domestic disregarded entity. And why would you do this? Well, the answer is in some countries, in order to have a business entity, you have to have a minimum of two owners. And so you do something like this. You have a domestic LLC that's an owner, and you have the human being as an owner. And now you've got two owners of this foreign eligible entity. You're good to go in that country. Well, you'll see the RevProc Rev rule listed below there. And that said flat out, in a situation like this, it was a pure domestic context, but the same rule extends in the foreign context, that there is a single tax owner of this foreign eligible entity. Now, the second one from the left is slightly different. It's a grantor trust now. It's not a disregarded entity. Important to note, remember, a business entity is not a trust. Well, a grantor trust is for sure a trust. And so the grantor trust can never make a check the box election, but remember section 671 says that the grantor of a grantor trust is treated as the owner of the trust. And the IRS extends that logic to say that we treat the grantor as owning the assets of the trust. And that PLR, which of course is not valid for authority, but everybody relies on it, says that this is a single tax owner in this context. The third one from the left, two grantor trusts. Well, that's just an extension. If you have one grantor trust and one human as the two owners, you have two grantor trusts, it should be the same thing, right? So we have, again, a single tax owner. Now, this sounds far-fetched. Why would you do it? Well, the far right is stuff that I have actually seen and we've actually worked with. You have a US citizen living in Australia, and they've been there a long time, and they do what Australians do, and they set up the typical Australian trust for normal estate planning. And that trust almost invariably is going to be a foreign grantor trust per section 679, if no other reason. 679 says if a US person sets up a foreign trust and there's a US beneficiary, or there might be, then it's a foreign grantor trust. The other reason is because the way these things are set up is that the US citizen sets up a limited company, is the 100% shareholder of it. That little limited company is the trustee of this trust. Well, if you look at that big picture, that means that the citizen has the full trustee power which is a retention of all administrative rights, which makes a retained interest and makes a grantor trust. So it'll be the typical Australian family trust is going to be a grantor trust when a US person sets it up. And then, people of a certain amount of money will have their super fund set up as a self-managed super fund. And that too is a grantor trust because it's baked into the name, self-managed. And so you have a thing that's a trust, and you have a US person who set it up and is also the beneficiary, Section 679. You have a US person who is functionally the trustee and can decide when to distribute and when not to distribute within the confines of Australian law. And so it's a grantor trust. And so what you have is you have this Australian partnership, which from an Australian law point of view has two partners and therefore is a partnership from the Australian perspective, but is a disregarded entity from US point of view. So this is how one of these things can come up in real life and can actually bite you in the bum. Now, back to this idea of tax owner. In these three examples, I have a corporation, a partnership, and a non-grantor trust. These are not disregarded entities. They're the entities in their own right. A partnership is a pass-through, sure, but it's its own taxable entity, and tax calculations are done at the partnership level. Non-grantor trust can be a pass-through if it chooses to make a distribution to the beneficiary and pass through the tax attributes and income and whatnot to the beneficiary, or it can be its own thing. So in all cases, in these situations, the human is not going to be the tax owner of the foreign eligible entity. The entity that is the sole member of that foreign eligible entity is going to be it. So the human is not going to have the ability or the requirement to file Form 8858. So now we've come to one owner. Next, let's talk about how the disregarded entity becomes disregarded. And there are two ways: by default classification and by election. Default classification. Here's the easy thing, ask yourself first, under the relevant local law, do all of the members of this or all of the owners of this entity have limited liability for the entity's debts? Yes or no? If yes, it's automatically an association, which is classified as a corporation. If no, the next thing you have to ask is how many owners are there? If there's one, it's going to be disregarded. If it's more than one, it's going to be a partnership. So couldn't be easier. You've decided you only have one tax owner. You've decided that under the relevant local law, there is unlimited liability for at least one of the owners. A limited partnership has a general partner that has theoretical unlimited liability, and the limited partners don't. Therefore, it's a partnership. Even if you put a corporation as the general partner and you put about 74 cents in the corporation as general partner, in theory, that general partner corporation has unlimited liability for the partnership's debts. So it works. So the quick and easy example, and I pulled this from the regs, and because it's the one that most commonly comes up, it doesn't commonly come up in my life, but I just want to show you how it works. You have this Nova Scotia Unlimited Liability Company. It's specifically called out as not being a per se corporation in the regulations. And so as a result, it's not a per se corporation, so it's a foreign eligible entity because it's a business entity. And we have unlimited liability and we have one owner. Therefore, its default classification is disregarded entity. Again, I never see that. This is where I live, in a classification by election, doing the check the box election itself. And when we're talking about specifically a foreign eligible entity, there's only one way it can go. It'll have a default classification as an association taxable as a corporation, and you want to make it into a disregarded entity. There's no possibility for the third choice, partnership, because there's only one owner and you have to have two or more owners to make it a partnership. So here, there are two things you have to do, one of which is make the election, and number two is make sure you didn't make an election in the previous 60 months to change its default classification. Making the election part, I'm just going to give you this slide because there's nothing boringer than, remember to check box C. You know how to read the instructions. But let's talk about some of the concepts behind the check the box election. And the first one I want to talk about is relevance, because I had this wrong in my head for the longest time. Here's my old Phil's thinking about how the check the box election worked for a foreign eligible entity. I thought that you were not even able to make a valid check the box entity, valid meaning it converted the classification from association to disregarded entity, until there was relevance. This is not true. You can make a check the box election for a foreign eligible entity, even though it does not have relevance. And I'll talk about what relevance means in a second on the next slide. So this is an important thing for me to learn. And what this means is, in the bad old days, old ignorant Phil, I would create relevance by putting a tiny little US asset inside a foreign eligible entity. What tiny little asset would I use? Well, maybe I would have the foreign eligible entity loan $1,000 to a US person, and therefore it would create relevance. I've done, in the context of big corporate structures, I form a little teeny tiny USC corporation and sell a share for $1 to a foreign eligible entity, and now they have a US asset and I can create relevance. I've done stuff like that, but you don't need to do stuff like that unless you want belt and suspenders certainty. Here's what relevance means. Relevance means that a classification of a foreign eligible entity makes a difference for the tax liability of anybody or for the US tax reporting requirements for anybody. So for instance, you have a Bahamas corporation owned by a non-resident, and the Bahamas corporation opens an account at Interactive Brokers so it can trade stocks and bonds. Depending on the classification of that Bahamas corporation, you will be giving different members of the family of W8 to Interactive Brokers so they know how to do withholding and all of that sort of fun stuff. And so there's an example of this affects the reporting. Let's say you make a check the box election for this Bahamas corporation, and the ultimate beneficial owners behind the Bahamas corporation is a UK resident individual. Okay, now it makes a difference for the withholding purposes, because you can trace withholding all the way upstream, and on dividend withholding use the treaty rate instead of the default 30% rate. So this is the idea that the classification makes a difference to tax costs or paperwork. But relevance is not required for valid check the box election. And the canonical source of data for this is going to be this advice memorandum, AM 2021-002. And if you ask the almighty Google for AM 2021-002, you'll get it. Or you can ask your favorite tax resource. And this is AM advice memo. This is Chief Counsel's office sort of giving generic advice on the meaning of the law. And this thing tells us flat out that the definition, think about it this way, the definition of a corporation or a partnership and of foreign or domestic is hardwired into section 7701A of the Internal Revenue Code. And the definitions do not include anywhere in 7701A the word relevant or relevance. And so we know from that that classification for US purposes does not require relevance. So now how do we apply this to the check the box thing? What you say is the advice memorandum says, of course, an entity, including a foreign entity that never touches the US tax system, has relevance. It has it has classification, because the classification is important for tax purposes someday in the future, maybe. Like you have a foreign corporation and you need to know E&P, because someday, what if it becomes a controlled foreign corporation because a US shareholder buys in? Now it's really important to know what the historical E&P is for this corporation. So of course you need to know at all times what a classification is for an entity. And they'll give an example in there, and we'll talk a little bit more about this. In fact, let's talk about it now. Where a foreign entity with no relevance, never has, makes a valid election and the election is effective. So this is what's called situation 2 when you read it. So you have two non-resident individuals, they form a foreign business entity, and they have unlimited liability for the entity's debts. So it's a partnership by default. That's on date 1. So you start with this thing is a partnership on date 1. On date 2, one buys out the other. So now you have a foreign business entity, which is a foreign eligible entity that has one owner, and by default, it is a disregarded election. And then on date 4, after date 3, the foreign eligible entity makes a 8832 election, backwards valid, with an effective date prior to the date of filing the election, which is allowed. And it says, I want to be classified as an association. And the result, when you read the analysis in the advice memorandum, is that on date 3, X changed successfully from being a disregarded entity to an association for US tax purposes. So note what happened. This thing doesn't touch the United States at all, either by ownership or by assets or by income or by activity or anything. But the Internal Revenue Service thinks that this is an association classified as it's a foreign eligible entity, and it's classified as an association. So the practical application of this, simple example, which I'm sure all of you know, is the pre-immigration situation. If you have somebody who has it has a corporation that holds a bunch of assets in it, and this person is going to become a US resident, then you make a check the box election before the date that residency commences. And by doing so, this is a deemed liquidation, and we'll talk about that in a little bit. And the non-resident is treated as if the corporation distributed all the assets directly to the non-resident alien, and the non-resident owns those assets directly as a human being. Hey, presto, with a basis step up. So this is a classic situation, and my experience, especially with people coming from Asia, is that holding companies for passive assets and indeed active assets are very, very common. And so this is a way that you can get a step up in basis of assets prior to immigration. And at the same time, Form 8858 sucks less than Form 5471. So why wouldn't you? Now, so why do they have this relevance thing in the regulations? And the answer is it matters only because of the 60-month rule. This is the rule that says once an entity has elected to change its classification for US tax purposes, it cannot do that again for another 60 months. Asterisk exceptions apply. So what is this? And I will cut through the noise here, but what Advice Memorandum 2021-002 says is that the way that the Chief Counsel's Office reads it, they are saying that when, in that situation 2 example I just gave you, when that election is made, that created relevance on that day, the date of the election. That's the first thing. And then the second thing they say is because of that, this is treated as if it's the initial election at the date of formation of the company. So we ignore all the prior history of this foreign eligible entity, and we just say we pretend that it was formed on the date the Form 8832 was effective. And the consequence of that is that this is the initial classification, and section 301.7701-3C1 Romanet 4 says that this is not treated as an elective change of classification. It's sort of like your classification from ground zero. And therefore, in the little situation 2 example, if we wanted to extend it, on date 5 at some point in the future, let's say 24 months from now, the sole owner of this thing wanted to say, oopsie, another 8832 could be valid. It's still within the 60-month period, but it's a valid election to flip it back to disregarded entity. The bottom line for you and me who deal with all of this noise in the beginning is relevance only matters if you have a 60-month problem. Then you have to go through all this brain damage to figure out this stuff. It's hacky. What happened was the original check the box final regulations were written badly. The advice memorandum, I think, is just a sort of hacky way that the government papered over an obvious drafting problem in the original regulations because they didn't want to go through and amend the regulations because that's too much paperwork. And so what they've done as a result is they've left this just trail of confusion where you have to understand a bunch of nothing, and the cognitive load that they've put on the rest of us out here in the real world to figure out what the hell is going on, just so they could save themselves a few hours of paperwork, I think is abysmal. And I am not bitter and I do not judge, but I think they should go clean it up at the regulation level instead of doing BS like this. Tax effect. Okay, what happens? Easy peasy. Association to disregarded entity. What happens is this election is treated as if you dissolved the company, you made a liquidating distribution, and end of story. And whatever the tax results are of that, it is. And in the context of a human being owning a corporation, it's going to be a taxable liquidation, of course, and so be it. The effective date of the election and the date of the deemed liquidation, this is the key part, and this is where it's important for your practical purposes. You make an election, and the deemed liquidation happens on the day before the effective date of the election. And I'll show you in the next slide why this is so critical. So let's say someone becomes a US resident and they come and knock on your door on February 1. Hey, I'm here. I got a green card. And you know that they're a US resident for calendar year 2025. And you say, oopsie, you own a CFC. Let's fix that. You quickly file a Form 8832 with a valid effective date of January 1, 2025. Okay, so starting January 1, 2025, this foreign corporation that has a bunch of stuff in it that you wish didn't exist as a CFC, on January 1 is a disregarded entity for US tax purposes. The liquidating distribution happens on December 31, 2024, and in 2024, this individual is still a non-resident alien. Therefore, if this foreign corporation had no US assets in it, the deemed liquidation is a nothing burger for US tax purposes. And from in terms of just real life, you still have a corporation in the foreign country. The foreign corporation still owns its assets in the foreign country. So nothing has changed, in real life. You don't have to retitle any assets. All you've done is you fixed the tax attributes of the whole situation. And this is something that we use a lot in pre-immigration situations. And in fact, if it's cost effective, it's worth spinning up a corporation, shoving a bunch of assets into it, and then doing a check the box election for this thing just to get the basis step up. So here are the references to section 331 and 336 that say what the tax effect of a taxable liquidation are. If you have a parent subsidiary, it's a tax-free liquidation, which doesn't really help you all that much. It helps a bit. You get rid of one CFC, but you might have an upper tier CFC. But this is how it works. All right, we've dealt a lot with foreign disregarded entities. Let's deal now with foreign branches, which are a lot easier to identify, more or less, and a lot easier to understand. Again, we have a drafting problem. We have this thing called a foreign branch. We have this thing called a qualified business unit. And we have the instructions to Form 8858 saying a qualified business unit is a foreign branch. So just think of a qualified business unit as a subset of the class of foreign branch, genus, species, one of the species in the genus. And a US person's business activity can be a foreign branch or it can be a qualified business unit in its own right, or both. So it doesn't matter what you have, just as long as you have a suspicion that you have a foreign branch or a qualified business unit, you have a US person operating it, you have a Form 8858 filing requirement. Now, foreign branch defined. The instructions tell us to use this definition of foreign branch in the Section 367 regulations. And what does it mean? It means an integral business operation carried on by a US person outside the United States. And you say, well, how do I know what that means? And the government says, facts and circumstances. And in the real world, it's not a problem. At the edge cases, you might have a problem. Frankly, in the edge cases, it's probably better to overpaper things if you can. And note this final sentence after I removed a bunch of the extra wordy words. It says, key word, an individual can have a foreign branch, which is kind of counterintuitive, but at least it's consistent. So we have an individual has the possibility of having a foreign branch. And because a qualified business unit is a foreign branch, an individual has the possibility of having a qualified business unit. And my final bullet point down the bottom is, for God's sake, don't use the other definition of foreign branch in the Section 904 regulations. Now let's look at examples. So you got a US person, me, I moved to the UK and I do US tax law as a sole trader there, sole proprietor here. What am I? Do I have a foreign branch? Well, the first point is, if I have a thing called a permanent establishment, which is a treaty definition, that is an automatic foreign branch. So I have an office and I work out of that office in the UK and I'm giving US tax advice to people. I have a foreign branch because I have a permanent establishment. Therefore, I've got an 8858 filing requirement for my little tax practice in the UK. Qualified business unit, what is that? Again, note that an individual can have a qualified business unit. The two requirements are trade or business and separate set of books and records. Well, go back to my point of me sitting in the UK giving US tax advice to people as a sole trader there, sole proprietor for US definition purposes. My activity at trade or business, yeah. Do I keep a separate set of books or records as a result of those activities? Well, yeah. I don't run everything through my personal checking account willy-nilly. Therefore, I've got a qualified business unit. Here's the definition out of the instructions for Form 8858 that says a qualified business unit is a foreign branch. And, again, talking about sole proprietorship, in my opinion, anytime you have a sole proprietorship for a U.S. individual abroad, you're going to have a qualified business unit, which is a foreign branch. You might have a foreign branch under the definitions of 367, but you've got an 8858 problem here. The other more interesting one is foreign rental real estate. And this one, there's the definitional, you have two things. Remember, you have to have a trade or business, and you have to have separate books and records. Well, you have rental activity, you're going to have separate books and records to track everything on that. So the next question is whether your activities with respect to that rental business rises to the level of a trade or business. And this is the classic question of real estate investors. At what point do I transcend mere investor status into active trade or business? And I can't give you a good answer, but it's going to be multiple properties and you're pretty busy. And so for people who buy rental property abroad, this is going to be a difficult question to answer because there's no bright line. If you've got a couple Airbnbs, that kind of looks like an active business. And yeah, you can outsource it all to a management company and argue that you're just an investor. But maybe you want to file, you have a QBU, a qualified business unit, with respect to those rental activities, and you file an 8858 for it. So discretion is the greater part of valor in this situation, particularly, I will point out, when it comes to the penalty situation. There are no penalties if you don't do it, but I would just do it and be done with it. But you give the client the choice, actually. So that's where we are on foreign branches and qualified business units. And the individual abroad situation is the one that I see most commonly. In the context of a real business doing real business abroad, opening an office and whatnot, there's never any question. Now, finally, before we get to penalties, categories of 8858 filers. 6 of them. 5 edge cases, 5 and 6, I'm going to absolutely skip. One of them is where you have a partnership that has Section 987 gain or loss, that's currency gain or loss, and they've made an election to have that gain or loss recognized at the partner level rather than the partnership level. That's pretty esoteric. The other one is a partnership that has dual consolidated losses, and you check box 11 on K2 and K3. That's pretty esoteric. So in our real life, we're not going to be dealing with those, but we are going to be dealing with categories 1 through 4. So let's walk through those. The first one is, remember we talked about what's a tax owner? So categories 1 and 2 are for tax owners. Categories 3 and 4 are where you have a controlled foreign corporation, a controlled foreign partnership that has a branch or a disregarded entity hanging underneath it. So category 1 filer, this is what it looks like. Human owns disregarded entity. Human has a foreign branch, including a QBU. Human has a foreign grantor trust that owns a foreign disregarded entity. Remember, that was from our previous discussion showing that the human through a grantor trust is treated as the tax owner of the foreign disregarded entity. And a domestic disregarded entity. So Delaware LLC, disregarded for US tax purposes, owns a foreign disregarded entity. That's going to be a category 1 filer. Category 2 filer is where you have a foreign disregarded entity owning another foreign disregarded entity, or you have a foreign disregarded entity that owns a foreign disregarded entity or branch, either way. Or indeed, I don't even have it on this, but I should add it, which is you have the human has a foreign grantor trust that owns the foreign disregarded entity. And that could easily happen. Again, Just recalling Australian situations, a family trust owns a limited company, you make a check the box election, and you're done. You have the foreign grantor trust, and then you have the disregarded entity, and hey presto, Form 8858 for the disregarded entity. Category 3 filer. This is controlled foreign corporation, and it's only for Category 4 or Category 5 filer of 5471. And this is going to trigger an 8858 filing requirement for the human, not for the controlled foreign corporation. And you know why? It's because the IRS has jurisdiction and can say your money or your life to the US citizen that is the shareholder in the controlled foreign corporation. The IRS does not have jurisdiction over controlled foreign corporation, which is a foreign corporation doing business abroad, and therefore they can't force the CFC to do anything. Same thing for controlled foreign partnership, only for Category 1 or Category 2 filers of Form 8865. If the controlled foreign partnership owns a disregarded entity, foreign disregarded entity, or has a foreign branch, then you're going to have a Category 4 filing requirement for the individual partner. Finally, let's wrap up with penalties. Why Category 1 and Category 2 filers are not at risk? The answer is that the IRS does not, 5471 comes out of Section 6038. Form 3521, 3520, and 3520A have their own Internal Revenue Code section. Form 5472 has its own Internal Revenue Code section. 8858 does not have an enabling Internal Revenue Code section, meaning Congress didn't say, hey, IRS, go collect this data, and here's a penalty if people don't do what you ask them to do. And so they had to shoehorn it in. And the Form 8858 is kind of no different from, oh, I forgot to attach Schedule D to my tax return. You know, I missed a piece of paper, but there's no penalty. I just have to report the income, the capital gain. And that's the situation here. What they've done is they've shoehorned the 8858 filing requirement out of Internal Revenue Code Section 6038, which is for CFCs and controlled foreign partnerships. And in Section 6038, there's a hand-wavy section that says, and the IRS can ask for any more information that it wants, you know, to enable the smooth administration of the Internal Revenue Code or whatever it says, right? So sort of a blanket license to ask for more information. And that's the license that the government relies on to publish Form 8858. Well, if you look at Section 6038, it only applies to US persons who are owners of a foreign business entity. And what's a foreign business entity? And the foreign business entity is a foreign corporation or it's a foreign partnership. Well, a foreign disregarded entity is not a corporation, it's not a partnership, is it? Therefore, if you have a US person who is the sole owner of a foreign disregarded entity, then the penalty rules of Section 6038 don't apply because the penalty rules only apply to a US person who owns a US business entity, a foreign business entity, and doesn't file the right paperwork. Therefore, if you have a human, even through a stack of foreign grantor trusts and foreign disregarded entities, you're not going to have, or indeed a domestic entity, you're not going to have a Form 8858 penalty, which is the 10 grand, or losing foreign tax credit. Category 3 and 4 filers, remember this is the human US shareholder of a CFC or the US partner in a controlled foreign partnership, do have the penalty risks because see what they own is they own an interest in a foreign business entity, the CFC or the controlled foreign partnership. And the additional reporting requirements apply here to the US person who owns the US business entity and the fact, pardon me, the foreign business entity, the CFC or the partnership, and the fact that you've got a foreign disregarded entity or foreign branch hanging under the CFC or controlled foreign partnership doesn't make a difference. So that's why, when we're talking about sole proprietors abroad, should I do an 8858 or not? Well, you make the judgment call, you make a nice clean tax return. But if you accidentally miss the 8858 and you say, oopsie, am I at risk? The answer is no. Dan Price, PriceTaxLaw.com, used to run the IRS's streamlined unit. I've had this conversation with him, and he laughs and says, yeah, but they'll try to impose the penalty anyway. So, there you go. Anyway, here we go. We're wrapping it up. And my conclusion for this is 8858 filing requirements are usually easy to spot. It's usually pretty easy to figure out that you can make a Form 8858 check the box election, though some of us have been known to make an election for a per se corporation accidentally, because they were a little bit sloppy and a little bit moving too fast. And just take care when you see a semi-complicated holding structure. Look for this situation like the one I gave you for the Australians, where you have a family trust and a super fund as the two partners in a partnership, and it's not a partnership for US tax purposes at all. All right, see you next month. Next month will be a Form 5472 day. This is May 30, 2025. Again, 9 a.m. Pacific, noon Eastern. And I can't do head math this early in the morning to tell you what time it is Central European time. Talk to you next month. Get your friends on the mailing list. You can go on the mailing list at hodgin.com. There is a community of over 100 international tax pros. You can go check that out at pro.internationaltaxlaw.com. And we're having a conference in London on June 27, 2025. There are like 4 tickets left. So, check it out. If you're on my email, you got the email this morning about buying a ticket. Thanks so much, and I'm out of here. Bye.